Good morning, everyone. Today is our second session on Ind AS 113, and we should be in a position to complete the standard. Uh, the most important part we have discussed yesterday, that is the definition of fair value, where we saw that fair value is essentially a price. Which price? It is the price that would be received to sell an asset or paid to transfer a liability. So basically, we were talking about something known as an exit price. In an orderly transaction, so we saw what is an orderly transaction, a transaction without any duress, without any coercion, okay, in between market participants. So we saw who are market participants, any player in the market, not a related party, and in the appropriate market. So when we were discussing appropriate market yesterday, we saw that it basically meant two types of markets, a principal market and the most advantageous market. So the principal market essentially meant the market that had the highest number of buyers, highest number of sellers, greatest number of transactions. So ultimately, since the volumes are high, the buyers and sellers are high, naturally, each person is aware of the item being transacted, and therefore, ultimately the price would always converge to a fair value. And that is why if the principal market can be determined for a particular item, then we will not even look at the most advantageous market. We will stick to the principal market only. In case the commodity, the item you want to fair value does not have a principal market, you will then move on to the most advantageous market. And what is the most advantageous market? It is that market where the proceeds are maximized. So what do you mean by proceeds? Proceeds means the available price minus the transportation costs minus the transaction costs. When I say transportation costs, it does not necessarily mean the goods are going and getting loaded onto a truck or a ship or an air carrier and it is being unloaded at another place, and the cost for this is the transport cost. It's not necessary. As I told you, if you are looking at valuing an item of work in progress, a construction work in progress, then the cost to complete that would be regarded as an analog to your transportation costs. Okay. So transportation cost is essentially any cost that alters the characteristic of the asset, which is in turn making it saleable. Okay, so you are basically bringing it to a condition that makes it saleable. Okay, so that is how you can interpret transportation cost. So items like transaction costs like brokerage, commission, or securities transaction tax, these are all transaction costs, and transaction costs cannot be deducted while calculating the fair value because they facilitate the transaction. They do not they do not alter the nature of the asset. So while I determine the net proceeds by reducing the transaction costs, my fair value cannot be determined by reducing the transaction cost. It will just be available price minus the transportation cost. So that becomes your fair value. So these were the key items which we discussed yesterday. I hope it was clear to all of you. Anybody has any doubts, they can ask us right now. Otherwise, we will proceed with the next topic. Okay. Good morning, Uma, Namrata, Shriram, Asha, Tushar. Good morning. Good morning. Okay. So I trust that it was clear yesterday. You don't require any clarity. Anybody needs any clarity, any further clarity? Let me know, please. Any further clarity or discussion on that? If not, then we can proceed further. Nidhi is not there today. Sayyad. Was yesterday's session clear up till now? Anybody wants any clarity or discussion? Okay, it's clear till now. Okay, so now let us proceed with the next part. We will do one question. Okay, so I have two extra questions which are not there in the study module, and about 4 to 5 questions that deal with valuations. Okay, so I will be doing these questions for you because the remaining questions of the study module, the examples, the illustrations, these are fairly simple and I'm sure you will be able to solve them. Okay, so with this, I will just tell you what you have to do for homework, and what I will be doing here for you, I will be obviously solving. Okay, good morning, Miss Kayuri. Yes. All right. So I'm going to leave this discussion for homework. Example 10. Question number 1, I will be leaving it for homework. Okay. I will be doing the practical problem that is not there in the study module, but it is one which we are going to solve together. Okay. So read the question, please. Isha Limited operates in the agricultural sector, and apart from farming activities, it also has a division retailing agricultural vehicles. Retailing means selling. Okay. So it is into farming as well as selling of agricultural vehicles. It is currently evaluating a proposal involving sale of the retail division. So now what it is doing is it wants to dispose of the division entirely. It is not selling the vehicles per se. The vehicles will constitute inventory for Isha Limited, and valuation, that is the NRV of the vehicles, is covered under Ind AS 2. It is not covered under 113. But here you are looking at disposing of the entire division. So this transaction is not covered under Ind AS 2. This would go under Ind AS 105. Okay, so Ind AS 105 requires you to value at fair value less cost to sell, or book value, whichever is less. So the fair value mentioned in Ind AS 105 corresponds to Ind AS 113. So immediately don't jump and say that this is relating to inventory and inventory is not covered under 113. That is not the case. Okay. And accordingly wishes to fair value the inventory of vehicles. So you are fair valuing for the purpose of sale of the retail division. Okay. 3 markets exist for the agricultural vehicles within which Isha Limited has transacted regularly. Isha Limited wishes to determine the fair value of 250 identical new vehicles as on 31st March 20X9. The volumes and prices across the 3 markets are as under. So you are having 3 markets, one in Uttar Pradesh, one in Punjab, and one in Orissa. The sale price per vehicle in all the 3 markets is given. These are the historical volumes which are sold by Isha Limited. Okay, sold by Isha. That means this is the actual sales which have happened. Then you have total volume of vehicles. This is what is the total volume of vehicles which are dealt with in the respective markets. Okay, so it could include Isha as well as its competitors. Transaction cost per vehicle in the 3 markets is given, and transport cost to the market per vehicle is also given. Isha Limited wishes to value the vehicles at 3,91,000 per vehicle, as these are the highest net proceeds per vehicle. How did it get highest net proceeds? Well, it is looking at 4 lakhs minus 5,000 minus 4,000. Okay. And Uttar Pradesh is the largest market for Isha Limited's vehicles. Isha seeks your advice as to whether this valuation would be acceptable under Ind AS 113 fair value measurement. Okay. So quickly tell me, are you clear with the question? Yes. Have you understood the question? Okay. Then we shall proceed to do the valuation. Okay. So valuation is going to be we are determining the fair value. So it is essentially going to be sale price minus the transportation cost. Okay, it is going to be sale price minus the transportation cost. So what I want you to tell me now is, what I want you to tell me now is there a principal market among the three markets which are given to us? Is there a principal market? And if there is a principal market, which one it is? Good morning, Panu. Good morning. Tell me now. Okay. So basically, you have Isha Limited. Isha Limited operates in 3 states: Uttar Pradesh, Punjab, Orissa. What does it do? It is selling agricultural vehicles. Okay. So now currently it is having 250 vehicles. This is inventory. Okay. Now what Isha wants to do is it wants to sell this division, not the vehicles. It wants to sell the entire division. So for the purpose of selling the entire division, it has to do a fair valuation of its assets. Those assets include these 250 vehicles. So what they have asked us to do is they have asked us whether 250 vehicles, they have asked us to do the valuation for the 250 vehicles. Okay, so this is the question that is asked, and they have given two pieces of information. They have given Isha Limited's volumes and they have given market volumes. And you will have to calculate the what you can say, you will have to calculate the fair value. Okay, so this is the question that is there before you. This is the question that is there before us. Okay, so now what I want you to tell is, do I have a principal market or do I have to go by the most advantageous market? So I got two answers, one from Namita that Uttar Pradesh is the principal market, and Shriram is also saying that it is given that UP is the largest market, and that is why we will do the valuation, and it is not given that it is the principal market. So we have to choose the method of valuing on the most advantageous market. Uma is saying the total volume of vehicles is highest in the market. So therefore, okay, so fine. This is so I got some answers. Now see, first of all, when an entity has, when an item has a principal market, don't let go of the concept. Fair valuation is a market-based valuation. Always. It is an asset liability specific, market specific valuation that you are looking at. Okay. So if there is a principal market, we will not view the most advantageous market. That is the most important thing you have to check. The main thing is they have confused us by saying that Uttar Pradesh is the largest market for Isha Limited's vehicles. That means what? It is a market, but when they give this statement to us, this is entity specific. This is entity specific. Do I have to do the valuation based on entity specific markets? Answer is no. You will have to look at market specific, asset specific, market specific markets. Okay. The market which is specific to a particular asset where the volumes are largest. It may appear to us that UP is the major market, but that is because I am selling in UP. Ideally speaking, my goods have the maximum volume, not in Uttar Pradesh, but they have maximum volume in Punjab. So though I operate with maximum volumes in UP, the same goods are actually sold in greater numbers, in far greater numbers in Punjab. So obviously Punjab is the state where I have the highest number of sellers, highest number of buyers, greatest number of transactions, and therefore do I have a principal market in this particular scenario? I definitely have. Look at Punjab, 9,35,000 versus Uttar Pradesh 1,75,000 and Orissa 1,45,000. So therefore the whole crux is on the fact, the whole crux of this question is identifying whether a principal market exists. In this case, a principal market does exist because the volumes are themselves giving you a clear picture that these are our principal markets. That means this is the principal market, that is Punjab. And when you have the principal market visible to you, you will not look for the most advantageous market. You will straight away go for the fair valuation. You will straight away go for the fair valuation. And what will be the fair value? It is going to be the selling price minus the transportation cost. That's it. You will not even consider the transaction cost. So Punjab 3,80,000, 3,80,000 minus transportation cost 7,000. So this is 3,73,000 per vehicle is going to be your fair value. If you multiply by 250, whatever figure you get, I think you get 9 crore 32 lakhs 50,000. This is going to be the fair value of all the vehicles put together. Is it okay? Yes. So Miss Uma has told that the total volume of vehicles sold is highest in Punjab. So that is right. So the choice of selling is higher in Punjab. Obviously, yes. But after that, you have gone into the, but net realizable value and all that is not required. Okay. So Shriram, I hope you understood where the concept led us to. Okay. And Asha, I hope you have followed. Yes. This statement that Uttar Pradesh is the largest market is meant solely to confuse us. Okay. It is an entity specific principal market. But when I look at the definition of principal market, it can never be entity specific. It can be only asset specific. In this case, your agricultural vehicles, that is, say, for example, tractors, they are sold maximum in Punjab. So you stick to the principal market, that is Punjab, and therefore you will do the valuations accordingly. Okay. So we'll quickly write the answer to this question. Okay. I hope you understood the discussion. Okay, so we quickly write an answer for this question and proceed further. This is question 1. Okay, all right. Please write down. As per Ind AS 113, the fair value is the price to sell an asset. You first define the fair value. To sell an asset or transfer a liability, it is the price to sell an asset. It is the price, one second. Price to sell an asset or transfer a liability in an orderly transaction. In an orderly transaction between market participants in the most appropriate market. In the most appropriate market. Okay. So this is the definition of fair value. We shall now proceed to define the most appropriate market. The most appropriate market is determined as under. First one, principal market. This is the market where there are highest number of buyers, highest number of sellers, and maximum number of transactions are undertaken. For the commodity to be fair valued. For the commodity to be fair valued. In case a principal market is identifiable, it will be regarded as the most appropriate market for the purposes of determining fair value. For the purposes of determining fair value. Okay. So this is the first part. Second part, most advantageous market, where principal market is not identifiable, comma, where principal market is not identifiable, comma, fair valuation is done based on the most advantageous market. That is, the market which maximizes the net proceeds. And what are my net proceeds? Available price less transport cost less transaction costs. Okay. So we have now defined fair value. We have defined the most appropriate market. And now we shall apply this discussion to the question that is given. Okay. In the given case, comma, the maximum number of transactions with respect to the vehicles sold by Isha Limited, the maximum number of transactions with respect to the vehicles sold by Isha Limited have taken place in Punjab. Hence, Punjab represents the principal market for the said vehicles. The fact that Isha Limited has achieved maximum sales in UP is irrelevant since it is an. Okay, so write this down, then we shall continue. Okay. Noted down. Can we proceed further? Noted this. Can I proceed further? Yes. Can we proceed? Okay. The fact that Isha Limited has achieved maximum sales in UP is irrelevant since it is an entity specific information which cannot be considered in fair valuation. Okay. Therefore, fair value is equal to sales price less transport costs. This is in Punjab principal market. 3,80,000 minus 7,000. 3,73,000 per vehicle. Therefore, total fair value is equal to 3,73,000 into 250 vehicles. Rupees 9 crore 32 lakhs 50,000. Okay. Tushar, you are stuck somewhere. You are writing this down. Just have a look at this. Okay. And then this. Okay. Yeah. Janvi, Namrata, Tushar, Keyuri, Asha, Shriram. Yes. Anyways, many of you gave the right answer. So that's good. Viraj, hope you understood. Done. Total fair value 3,73,000 into 250 vehicles. So that comes to 9,32,000. 9 crore 32 lakh 50,000. The valuation of rupees 3,91,000 given by Isha Limited is incorrect due to the following reasons. First one, the prices are not considered based on the principal market as discussed above. Okay, you want me to go to the first page, Panu? Okay, just take a note of this. Yes, you have to first write the provisions, then the facts, and then the conclusion. See, basically, examination is the time when you display your knowledge. Okay. इतना सब मेहनत क्यों करते हो? उधर दिखाओ ना एग्जामिनर को कि मेरे को इंड एस आता है. यस, आपको दिखाना पड़ेगा कि मुझे इंड एस आ रहा है, मुझे मालूम है. तो प्लीज डिस्प्ले दैट. Make a huge display of the huge knowledge that you are having in the examination. Then you will get marks. Okay. I'm not saying write irrelevant things, but you have to tell them. If you give the answer in one page, in one line, 3,80,000 minus 7 into 250, उससे क्या पता चलेगा? Okay. So I need you to write the answers displaying the knowledge that you have accumulated. Okay. Done. Panu, Tushar, have you copied this? Yes. Okay, so I hope you have done this. Okay. The prices are not considered based on the and second one, without prejudice to point one above, comma, transaction costs are deducted in determining the fair value of rupees 3,91,000. which is not in accordance with Ind AS 113 as transaction costs are not a set specific costs. Okay. All right. Okay, so this takes care of the question that we have just now read. Once everybody has written, please let me know. Then we shall proceed to the next concept. Done. Janvi, Namrata, Keyuri, Asha, Shriram, Viraj, Namita, Uma, all done. Panu, Tushar, okay, done. All right. So that I think should take care of your question. Okay. All right. Now, this is clear enough. Okay. Now I had received a question which is okay to say, I mean, I won't say it's wrong or incorrect or irrelevant, but we had received a question in one of the batches. Okay. See, principal market is not there. It is fine. You will have to determine the most advantageous market. Now, where will you be determining the most advantageous market? कहाँ ढूंढते फिरोगे? Now, if you look at this question only, Uttar Pradesh, Punjab, Orissa, but will you see that the prices in all the states and union territories across India? Will you go and evaluate the pricing in each and every market and then say which is your most advantageous market? That was one question. The second question was, sir, what if the net proceeds are equal in two markets? What if the net proceeds are equal in two markets? Unfortunately, the standard does not give any guidance in this regard. Okay. When your net proceeds are same in two markets, you do not have any guidance in this regard. Okay. First point. Second point, there is one rebuttable presumption. Rebuttable presumption means what? It is an assumption that is there that the market in which the entity is transacting, if there is no principal market, the market in which the entity is transacting, that itself is the most advantageous market. Okay, so this is the rebuttable presumption that is there. And it is fairly true also to a great extent. Why is that so? See, if you are finding that your asset has a better price elsewhere, why are you selling it in the current market where you are operating? You can easily go and sell it elsewhere, which you are not doing. That means the market where you are operating, that becomes the most advantageous market. So this is the rebuttable presumption that is there, that the market where you are currently operating, that itself is the most advantageous market. Okay, so this is a rebuttable presumption which exists when you talk about Ind AS 113. And as far as the net proceeds being same for two or more markets, there is no specific guidance. What we can tell is where the volumes are high, you can look for that as the most advantageous market, and then you can say that this is the most advantageous market, so you can consider it. Okay, so in any case, since the net proceeds are the same, you can go ahead even for seeing where the fair value is maximized, and you can take that as the most advantageous market. Okay, because it does not say anything. So you need not be unnecessarily conservative and say fair value जहां पे कम है वहां पे value करेंगे. जरूरी नहीं है, it's not necessary. You can go ahead and do the valuation where you can take that market where fair value is higher. Okay, so this is the these are the discussions surrounding the definition of fair value. Okay, now we have 2 to 3 very important things, small things, not difficult. Okay, and conceptual, that's it. Okay, so now coming to valuation, you have 2 types of assets. The first one is a financial asset. The other one is a non-financial asset. So assets can be divided into financial and non-financial assets. So financial assets, layman's terms, I'm not talking in terms of the standard, layman's terms, these will include equity, equity shares, debentures, bonds, notes, etc. Okay, so the prime reason for making an investment in a financial asset is to get passive income like interest or dividend and capital appreciation. So these are the 3 things which you can get. So financial asset valuation is fairly simple because the cash flows are predetermined. मुझे मालूम है मेरा कैश फ्लो क्या होने वाला है. If it is a debenture, I know the interest which I'm going to get. I know the terminal value. I know the maturity value. Same applies for bonds, notes, etc. If you look at equity shares, the principle, the intent could be capital appreciation as well as the dividends which are being declared. So as far as the financial assets are concerned, your valuation is going to be fairly simple because the purposes are limited. The purposes are limited. You can easily determine the cash flows you are expecting from those assets. But coming to non-financial assets, this is where you will have a problem. See, if I have a parcel of land, what can I do on that land? And the scope is endless. The scope is endless. I can leave the land idle. Fair enough. I can use it as a dumping ground. मेरी मर्जी है, मैं जो चाहे अपने land पे करूं. So therefore I can use it as a dumping ground. I can use it as a parking space if it is closer to a mall or a place where you have lot of say weddings and functions, etc. I can give my land as a parking space and collect rent for that. I can build a hotel, a resort if it is in such a location. I can build a mall, I can build an office space, I can build shops, I can build residential complexes, I can build hybrid of residential cum commercials, I can build stadium if it is my own land, I can build a racing track for something like Formula 1 racing if I have that much land available. I can do anything and everything with this land as far as it is legally permissible. So these are the enormous possibilities I have with non-financial assets. Now the problem is, and this problem gets compounded by the fact that the cash flows under each of these options change. If I leave it idle, there is no cash flow except capital appreciation. If I use it as a dumping ground, there is no cash flow. The value will actually go down because it is a dumping ground. If I use it as a hotel, my cash flow is going to be different. It comes from tariffs, food and beverage services, etc. If I use it as a stadium, then ticket sale, matches, etc. will be the cash flows for you. If I use it as a residential complex, I will get it as installments from my customers. Same goes for commercial complexes, but they would be at a higher rate. So for each use, the cash flow is different. The cash flow is different. And because of that, standard setters felt that they have to give certain guidance for non-financial assets. So the guidance which they have given is the highest and best use concept. This is exclusively for non-financial assets. Okay. For assets, that is, for example, land, biological assets. Biological assets means assets like your cattle, your crops, etc. They come under biological assets. Okay. So what do you mean by highest and best use concept? It is a valuation concept that is used to value many non-financial assets. Example, real estate. And what is more important is the standard has given three very beautiful terms. The highest and best use must be physically possible, legally permissible, and financially feasible. All the three conditions have to be fulfilled. Let us assume that you have a 400 square meter plot. Okay. You have a 400 square meter plot. सोचने के लिए तो हम ये भी सोच सकते हैं कि 400 square meter plot में we could have a amusement park, something like Imagica types. Now, it may be financially feasible, but is it legally permissible? इतने छोटे से एरिया में आप क्या बनाओगे? And चलो एक बार तो legally it is permissible also, but is it physically possible? 400 square meters में what are the amusement park activities that you can do? Practically nothing. So it is physically not possible. Okay. Then, for example, if you want to use your land for carrying out, for example, you are going to carry out something which is illegal. Okay. Something which is illegal. Then is it permitted? Answer is no. You have cash flows, but it is not legally permitted. So the conditions that you must fulfill is it should be physically possible, legally permissible, and financially feasible. And trust me, when you are going to determine the use based on these three criteria, the market participant, not the perspective of the entity holding the asset. So it does not matter whether the entity intends to use the asset differently, Okay. And then to find out the best possible use, you identify the market participants, and then to find the best legitimate use of this non-financial asset, which one would normally do. Okay. So that is what you will consider. Restrictions specific to market participant would not be considered. Obviously, it is a market-based valuation. So restrictions specific to an entity, you will not be considering. You will be ignoring that. And this is the rebuttable presumption that is there. In absence of potential best use, which is not easily available, current use would be considered as the best use. If you are having a resort on the land, that is probably the best use for you, which you had determined. Okay, though you can do X, Y, Z, N number of things on that parcel of land, but because you have chosen to have a resort in that premises, the current use would be the best use. This is also making, what you can say, this is also giving rise to the fact that all entities are rational in making use of their assets. And that is why this is the presumption that current use would be considered to be the best use. And finally, while considering fair value under any alternative use, deduct the estimated cost to be incurred in order to make the asset ready for alternative use. So suppose you have a plot of land. I was discussing this yesterday as well. You have a plot of land on which there is a old building. There is an old building. and you want to use this for capital appreciation. ये मेरा land है, it is in a pristine property, for capital appreciation only I have kept it. Okay, but suppose somebody else comes and offers you a very good price, suppose, okay, I'm not saying you do that, I'm saying suppose. Then if that pricing is fairly high compared to what is your expectation, then you can take that as the fair value. But the expected price that you have is for the land, whereas on your land you have a building. So deduct the cost of demolishing that building, and the differential is going to be your fair value. The differential is going to be your fair value. It is like a cost that is altering the nature of the asset, something similar to transportation cost. Okay, so that takes care of this concept, which is the highest and best use. Where you will apply it only to non-financial assets. This is most important for us to remember. You will apply it only to non-financial assets. Sir, why not financial? Because financial assets ke case mein, the use of that asset, investment, is very limited. Okay, it is only for either capital appreciation or dividends or interest. That's it. So we know the cash flows which are going to come, and that is why the valuations of financial assets are fairly straightforward. When I say straightforward, I don't mean easy. I just mean that they just have a defined pattern of cash flows. That's it. Okay, so this is your highest and best use. So I am going to leave these examples for homework. Please go through them. Okay, please go through them. These are all very simple examples. Okay, should not give you any problem. Okay, so is it okay? Are we comfortable with highest and best use? Any doubts, anyone? Yes, any doubts? See, all the questions which I have skipped, they are all theory questions. Okay, कहीं पर मुझे कहीं कोई भी number नहीं नजर आ रहा है. Okay, so therefore I want you to read them and go through them as homework. It's very simple to understand. Is it okay? Have you understood so far? Yes, please confirm. Janavi, Uma, Shriram, Asha, Panu, Tushar, Namrata, Namita, all clear? Okay, fine. All right. Now, coming to the next part, that is valuation techniques. Okay, coming to the next part, that is, we now discuss valuation techniques. You know fair value. You know the valuation which is done, and now we shall come to the valuation rule. We shall now come to the valuation rules. Okay, and that is where we end up with some more problems. Okay, 3-4 problems more, but the solutions I have already shared on the portal. I shared it, I think, late last night or today morning. Okay, something like that. It should be available to you. So therefore, I need you to pay attention to this. This is the, you can say, the second last part of the standard. Then we move on to liabilities and equity, which is not so technical. Okay, not so technical. Okay, so now, if you do not have a market price, if you do not have a market for your asset which you are valuing, then how you do the fair valuation? So this requires the use of valuation techniques. So my fair value, the first option is to look whether you are having a market value, Namita, as a rebuttable principle, so 1 point in high. I didn't get your statement. Please tell me, what do you want to say? Okay, all right, fine. So fair value, first choice, market value. And if you have a market for your commodity or investment or asset or liability or equity, whatever it is, then take the market value, that becomes your fair value. That is fairly simple. But if there is no market value, then you have to determine, you have to compute, you have to arrive at. See, fair value is not any fruit that you pluck from the tree and use that value. Fair value is a computed value. It is a scientific value. You determine the value based on the principles enshrined in 113. So it cannot be any XYZ value. For each number that you are generating, it has to be backed by significant evidence why you have considered that particular number. So market value and non-market value. That means usage of valuation techniques. That means usage of valuation techniques. Okay. So what do you mean by valuation techniques? What do you mean by What do you mean by valuation techniques? There is a fundamental rule in Ind AS 113. What is the rule? When you are determining the fair value, you have to remember this. Maximize the use of observable inputs and minimize the use of unobservable inputs. This is the fundamental rule that Ind AS 113 tells us. Maximize the use of observable inputs and minimize the use of unobservable inputs. Sir, iska matlab kya hai? Let us understand with an example. You are a company A Limited. In your balance sheet, you are having investment in Tata Motors. You are having investments in Tata Motors first. Second one, you are having investment in Volkswagen. Equity shares of Volkswagen India Private Limited. Then the third case, you are having an investment in, I think Swiggy is not listed. You are having an investment in Swiggy. Zomato got listed recently. Swiggy is not listed. Okay. You are having it in Swiggy, or take any of those startups that have come on, that are in recent news. Okay. Cred or whatever you want. Okay. And now you have to do the fair valuation of these investments, because Ind AS requires us to do a fair valuation of investment in equity instruments. So now you will have to do the fair valuation. Now, when you do, what I'll do, I'll ignore Swiggy. We'll write something else, which is a unique one. In one of the space companies, okay, let us take a company called Agnikul Cosmos Private Limited. Okay, because Swiggy has a comparable, so that is why I did not take that. Okay, so you have these three companies where you have invested in. Now, it is end of the year. You have to do the fair valuation of your investment in equity. So now you open your balance sheet. You notice that there are three entities. So first thing, you approach the valuation of Tata Motors. What happened to this? 1 second. Just a minute. Where did my pencil go? One minute. I pressed something. Okay. Yes, Tata Motors. If I have to fair value Tata Motors, I have the following options. First one, price on NSE. Straight away take that value on 31st March, put it in the balance sheet. That is going to be my fair value. Well, I also know why I am holding Tata Motors. It is for capital appreciation and I getting the dividends periodically. So when this is the case, I can also do a discounted cash flow approach by determining what is the cash flows that Tata Motors will earn in the future and coming to the present value of the same and mentioning that this is going to be my fair value. Now you tell me which you will prefer. Will you prefer this, the price on National Stock Exchange, or for Tata Motors, will you prefer to carry out a discounted cash flow approach where you will end up estimating the value? Which method you will prefer? Both are permitted. Both are permitted. One is a discounted cash flow approach where you determine the value by estimating the future cash flows and discounting them to the present value using a discount rate. So this is one method which is definitely permitted. The second method is you look at the price of Tata Motors on the stock exchange and take that as your fair value. Which one will you prefer and why? Which one will you prefer and why? Namrata, Asha, Panu, Viraj, Janvi, Uma, Shriram, Namita gave the answer. Yes. What about the others? Tell me, which one would be more fair according to you? Which one would be fairer? Yes. Come on, tell me quickly. Uma is saying we will prefer NSC. What about the others? What about the others? What about the others? Market value easily available. Okay, great. So I think most of us are giving the answer that it is going to be the market value. One is they are saying it is easily available. Most of them have said that, which is fine. But I'm not going to take market value just because it is easily available. I will prefer market value compared to a discounted cash flow approach because in the DCF, there are a lot of unobservable inputs. There are a lot of unobservable inputs. What are the unobservable inputs? What will be my future profit? What will be my turnover in the future? What will be the basis for determining the discount rate? Why do I consider weighted average cost of capital and not incremental rate of borrowing as the discount rate? So there are innumerable unobservable inputs. And when I talk about unobservable inputs, since there is no reference point for me, it is all based on my assumptions, my estimates, my expectations. So therefore, there is a large chance of bias. Bias means what? Prejudice. There is a large amount of adjustments that you could do only to show that the valuation is better, expected, in line with what you expect. Okay. So to ensure that there could be a large number of, there could be a great amount of bias. I'm sure you would have encountered bias at all points of time since you are articled assistants. Okay. We all know many times how the finalizations happen. at several private limited companies. Okay, so you know the fact that inherent bias cannot be avoided when you are doing some computations. So that is why we will not prefer a DCF method when you have an existing price on the National Stock Exchange. And therefore, we are going to maximize the use of observable inputs. In this case, the price on National Stock Exchange is an observable input. Take that as the fair value and finish it off. Take that as the fair value and finish it off. Is it okay? So this is the meaning of observable inputs, maximizing the use of observable inputs. And what you want to do, you want to minimize the use of unobservable inputs. Okay, so unobservable inputs is, say for example, a DCF method. But there could be companies where unobservable input is the only way of doing a valuation. So in that case, you don't have an option. Take for example, a company like a space company in India, that is Agnikul Cosmos Private Limited. Now, the comparable company for Agnikul does not exist. It is ISRO, which is a government organization, which is not comparable. So therefore, when I have to do a valuation of this entity, I have to rely solely on the discounted cash flow method. This is how I will do the valuation. Okay. And in case you do not expect any further cash flow arising from here because it is a startup, then you will have to look at certain other methods of valuation, like the venture capital method or whatever methods of valuations are there. Okay. So therefore, there will be an inherent bias in the methods used to value the shares of Agnikul Cosmos because it is not traded on the market and there is no comparable company. So what you are going to do is you will maximize the use of observable inputs, minimize the use of unobservable inputs. But there may be some cases where DCF or unobservable inputs is the only way forward. At that point of time, you will have to take that as the method of valuation and continue. Coming to the second company, that is Volkswagen Limited. Now, this is a private limited company which is dealing in vehicles, So therefore, if I have to do the valuation of Volkswagen, I have two options. One is I pick up the DCF method. Second is I will look at the price of a comparable company on the stock exchange, and then I will have to make certain adjustments. So now what I can do is, for Volkswagen Limited, I will look at Tata Motors price and then make certain adjustments. Well, what could be the adjustments that you will be making? What will be the example of what will be a Tata Motors plus adjustments? Okay. So now in this case, you will look at Tata Motors price and then you will do certain adjustments. Sir, adjustments like, sir, Volkswagen Private Limited shares are not tradable in the market. That means your shares are not so liquid. And if they are not so liquid, then that would mean you will have to make an adjustment for liquidity. Because aaj to aapne share khareed liya. But tomorrow if you want to sell, where are you going to sell? To whom are you going to sell? On the stock exchange, it happens regularly. But outside the stock exchange, for unlisted entities shares, finding a buyer is very difficult. So that is known as illiquidity, unable to liquidate your shares. So you will have to make an adjustment, say for example, that one. Okay. So Tata Motors price on the stock market, that becomes an observable input, and adjusting it for liquidity discount, to determine Volkswagen Private Limited's shares. So that is what is going to be your value. Okay. So now you tell me You tell me now, for Volkswagen, which one would you prefer? Would you prefer the first part, that is Tata Motors plus adjustments, or will you prefer the second part, that is the discounted cash flow method, where you do the valuation based on the cash flows that you have assumed to arise in the future? Tell me, which one would you prefer? Which one would you prefer? Tata Motors plus adjustments or only the DCF value? Which one would you prefer? Just give me a minute. Okay. So Tushar is saying he would prefer the first option, that is Tata Motors plus the adjustments. Uma is saying she will prefer the DCF. Janvi is saying she will prefer Tata Motors with the adjustments. And Namrata is saying how to determine which entities should we consider for the purpose of observable inputs. Good. So I have a variety of information. So now look here. I am having Volkswagen. This is a company that is dealing in passenger segment cars. Passenger segment cars. Okay. It is having a wide variety. It could be having family sedans, for example. It could be also operating in the luxurious sedan segment. Okay. It could be operating in the luxurious sedan segment. Now, what you will be doing is, when you want to fair value Volkswagen, you will first of all look at whether there is any company, a listed one, that operates in the similar segment. I'm just explaining for example purposes. Don't take it literally. When I do that, I notice that I have Tata Motors. Tata Motors deals with, okay, 1 second, not Tata Motors. I find that there is a company, Maruti Suzuki. Okay. Now, Maruti Suzuki is a listed company. And if it is a listed company, I have an observable price. And like Volkswagen, Maruti also deals in passenger segment cars. And when it deals in passenger segment cars, Suzuki has hatchbacks, Suzuki has sedans, Suzuki has SUVs. Volkswagen also has SUVs. Okay. So this is the broad categorization of Volkswagen and Maruti Suzuki. So how do I know which entities we need to compare? That is what you have to study when you are doing the fair valuation. If you want to go for the first criteria, that is taking the price of a listed company, in this case I remove Tata Motors and I have taken Maruti. Okay. I have taken Maruti. Okay. So now you have to identify मेरे जैसा similar organization कौन सा है which is listed, which is the organization closest to my operations but which is listed. You have to identify that. That is an exercise the company has to do. So if Volkswagen says similar to my operations, only Maruti is there. Why? Because Tata is also dealing in commercial vehicles like trucks, etc., which I do not deal. So Tata is out of the picture. Hyundai is an unlisted entity. So therefore, Hyundai, Skoda, all these are unlisted entities. So now you will say that only Maruti is the listed entity which is comparable to me. And therefore, you will pick up Maruti's price. You will pick up Maruti's segments where it operates. You will pick up Maruti's debt levels. Debt levels. Okay, so first one is the segment. Second one, you could possibly be checking the debt levels. That is something like a debt equity ratio. You will be checking the beta of Maruti. That is the sensitivity with the market. Okay, and basis that you will do a similar evaluation of your own company. You will check what is my debt levels of Volkswagen, because the company where I have invested, and basis that you will check Volkswagen versus Maruti Suzuki and identify where the things are different. And for each item of differentiation, you will do an adjustment. So what will be Volkswagen's prices? Maruti Suzuki price, whatever it is, plus or minus adjustments. Plus or minus adjustments. So this gives you the value. How to determine which company? That you have to identify. Which is the company, which is the, what you can say, which is the company that deals with similar products, has a similar capital structure like mine, and basis that you will determine the value. Whereas if I look at a discounted cash flow approach for Volkswagen, again it starts with a huge amount of bias. कैश फ्लो कितना होगा, फ्यूचर में कितना बेचेगा, फ्यूचर में प्रॉफिटेबिलिटी कितना होगा, व्हाट विल बी द फ्यूचर कैश फ्लो, व्हाट विल बी द फ्यूचर फंड फ्लो, व्हाट विल बी माय इंक्रीमेंटल रेट ऑफ बोरोइंग. ऑल दीज थिंग्स at every stage require an assumption, require a calculation, require a working, results in bias. So now after this explanation, after this discussion, I now want you to tell me which is more preferred. If you are looking for reliability of the fair value of Volkswagen, what would you prefer? Would you prefer Maruti plus adjustments, where the bias is limited only to the adjustments, or would you prefer a discounted cash flow approach where everything is subjected to bias? What would you prefer? Did you get my question? If I have to look at Volkswagen now and I'm valuing it, will I prefer Maruti plus certain adjustments where the bias is only going to be in the adjustments and not in Maruti's price, because that is an observable input? Or will you prefer a DCF jahan pe everything is a bias, everything is estimated, everything is a management estimate, starting right from turnover to the manufacturing cost, to the GP margins, to the NP margins, to the levels of debt, to the incremental rate of borrowing, to the weighted average cost of capital. Everything is an assumption. So what do you prefer? Obviously, if you were to ask me, I would prefer taking a comparable company such as Maruti, making certain adjustments, because in such a case, what happens is the bias is limited to only the adjustments. The bias is limited only to the adjustments and not to the pricing as a whole. So remember the thumb rule: maximize the use of observable inputs, minimize the use of unobservable inputs. Before valuing Volkswagen's shares, I have both the options. Which is the one that maximizes observable input? Sir, it is obviously the first method. Listed company with certain adjustments. So that gives you the fair value of Volkswagen as compared to DCF, where everything is unobservable. So what would you prefer between both of them? The rule tells you will prefer maximizing the use of observable inputs. So the first method is preferred. Viraj, did you follow? Uma, did you follow? Yes. Others, Shriram and all, did you follow? Shriram, Keyuri, Namita, Asha, Janvi, did you guys follow? Yes. Please tell me. Did you all follow? Yes or no? Okay. Mukesh has confirmed. Asha has confirmed. Viraj has confirmed. Okay. All right. So this is what you will be following. Okay. Now, what are the examples of observable inputs? Pricing of a similar company on the stock exchange. This is an observable input. Suppose you are wanting to value a residential flat. Then you could be looking in, I'll come to that, Tushar. Okay. Then you could be coming in to look at what is the latest price which has happened in the surrounding. Okay. And that could be a value that you could determine. Okay. That could be the value that you could determine. So these are all my observable inputs. These are all my observable inputs. Okay. Tushar is asking, sir, can we use a registered valuer's report? You will have to use a registered valuer's report. But tell me, a registered valuer kya karega? He will come, then he will put it in his format, do some working here and there and give the valuation to you. Yes. So ultimately, a valuer's report is based on data given by the management. And therefore, what would be better? A DCF would be better? No, because management bias is inherent in the DCF report, even though there is a registered valuer's signature. Because registered valuer's certificate mein what is written is, this is prepared based on the inputs given by the management. This is prepared based on the inputs given by the management. Okay. So if I have to talk about observable inputs, it could be first one, similar companies price on the stock exchange. This is the first observable input. Second observable input, locality, recently sold price of a property in nearby areas. Okay, so this could be another example of observable input. This could be another example of observable input. If I am proceeding to value my investment in debentures, then you will look at the pricing of the debentures, of similar debentures. Okay. Pricing of debentures on stock exchange. Anything which you can view and apply straight away, that will be your observable input. That will be your observable input. If you are going to sell a second-hand vehicle, your company had a vehicle, you want to dispose it off, then pricing on websites like OLX or True Value for cars, etc. So these could be the examples of observable inputs. You look at that value and you can take that to be the fair value subject to certain adjustments. So these are observable inputs. Examples, some examples. Okay. When you ask for unobservable inputs means estimate of future cash flows. किसके साथ ऑब्जर्व करोगे? You cannot observe it. It is your estimate. Your bias is there. You cannot compare it with any standard cash flow. You cannot have a case where industry publishes this should be the cash flow for car companies. अरे ऐसा नहीं हो सकता है. Okay, so estimate of future cash flows. Then the second one is observable inputs is done. Then unobservable estimate. Okay. Then weighted average cost of capital or incremental borrowing rate. Your WACC, which you estimate, is unique to you only. You cannot have similar WACCs floating on the market. No. Then your internal, incremental borrowing rate exclusively belongs to you. It cannot be observed with somebody else because whatever is their position, they will give according to that. Okay. For me, what is my incremental borrowing rate? I cannot observe it from anywhere else. It is my own, what you can say, it is my own value, which I have determined by myself. Okay. Then third one, what could be the costs of operations when you are determining the cash flows? So these are again unobservable inputs. These are again unobservable inputs. Did you follow? Yes, these are some of the examples of observable and unobservable inputs. Okay. So what the standard tells is maximize the use of the relevant observable inputs and minimize the use of unobservable inputs. Minimize the use of unobservable inputs. Is it okay? Have you understood? Yes. Observable inputs, they have told you based on market data obtained from independent sources. So I have given you that example. Yes. Then what do you mean by unobservable inputs? Based on entity's own assumptions about financial factors. Example, future cash flows, etc. So this is a highly subjective form of valuation. This is a highly subjective form of valuation. Did you understand? Yes. Have you understood? Any doubts? Anybody has any doubts? All clear. Okay. So now coming to the next part, based on these observable, unobservable inputs, we have a fair value hierarchy which is given in the standard. Level 1 inputs, level 2 inputs, level 3 inputs. So level 1 input, quoted price. Price dekho, put it in the valuation, put it as the fair value of your assets. Don't do any adjustments. You have gold, you want to fair value it. गोल्ड का आज का प्राइस देखो, मल्टीप्लाई बाय योर क्वांटिटी, गोल्ड का अमाउंट मिल गया आपको, फेयर वैल्यू. That is as simple as that. No bias, nothing. Straight away take the commodity rate, put it in your, put it against your gold and do the valuation accordingly. For those inputs, we call them as level 1 inputs. We call them as level 1 inputs. What is it? It is basically quoted prices, that is unadjusted prices. That is unadjusted prices in active markets for identical assets or liabilities. Identical assets or liabilities. Important word is identical. Okay. That the entity can access at the measurement date. Okay. Example, quoted prices of equity shares on the BSE or NSE. quoted price of gold held as an investment. So all these things will come under observable inputs. Straight away value, plug it as your fair value. Don't do any adjustment. Don't do any adjustment. Then we come to level 2. Okay. Level 2 means what? Level 2 is level 1 observable plus adjustments. Observable plus adjustments. कैसे करेंगे? Inputs other than quoted prices that are observable for the asset or liability directly or indirectly. And these include quoted prices for similar assets or liabilities requiring certain adjustments. You will need certain adjustments. For example, if you have a 21 karat gold available with you and pricing is there of 24 karat, what are you going to do? You will take the 24 karat price and adjust it to arrive at the arrive at the price of 21 karat. Okay, so you will take 24 plus the adjustment for bringing it to 21 karat gold. Okay, identical assets or liabilities means what? You are holding investment in Tata Motors. On the National Stock Exchange also, it should be Tata Motors only. So that is identical asset. That becomes your identical asset. Okay, that becomes your identical asset. All right. You are holding TCS, then you will have to pick up the price of TCS only. That is becoming your identical asset. Same asset or liability that you are holding, which has a quoted price in the marketplace, identical, then that will be taken as the level 1 input. Basically, no adjustment is permitted. No adjustment of any kind is permitted. Is it okay? Yes. Whereas level 2 inputs, it starts with the quoted prices included in level 1 plus certain adjustments. Okay. Like, suppose your 24 karat gold price today is, kitna pakdenge? Gold is gone through the roof. 55,000 for 10 grams. Okay, 55,000 for 10 grams. This is the quoted price. But you are holding how much? Suppose you are holding 21 karat gold. Then what you will do? If 55,000 is the price for 24, what will be the price for 21? And that is how you will do the valuation. Did you understand? Yes? Yes? Bolo. Yes? Yes? Have you understood level 2? Have you understood level 2? Mukesh has confirmed. Uma has confirmed. Asha has confirmed. Yes. So you pick up the quoted price, do some adjustments. This 21 by 24, this is an adjustment that you are doing. Okay. So 55,000 by 24 into 21. This gives you 48,125. This is the calculation. So between 55 to 48, the impact is on account of inputs. requiring quoted prices for similar assets, thereafter requiring certain adjustments, thereafter enjoying certain adjustments. Okay. And finally, when you go to level 3, Panu, you had certain doubt in this. Unobservable input. That means आप कहीं पे कोई reference point नहीं है. There is no reference point what you can view. This is totally abstract. This is totally abstract. So the hierarchy goes something like this. It is highly objective in the beginning, and by the time you come to level 3, it is highly subjective. It is highly subjective. So unobservable inputs for the asset or liability, which shall reflect the assumption that market participants would use when pricing the asset or liability, including assumptions about risk. Example, financial forecast. This we give. You cannot compare with anyone. Historical volatility required for valuing options under the Black-Scholes model, etc. So all these cases are where you do not have a comparative. You do not have a comparative. Yes? All right. Did you understand? Yes. No comparative case in the last scenario. Panu, did you follow? Panu, did you follow? Yes, Sriram has confirmed. So this is your valuation. This is your valuation. Okay. All right. So that takes care of valuation techniques, fair value hierarchy. I'm leaving these questions to you for homework. Okay. Leave these questions for homework. Okay. Go through this particular case. It's an important one from concept perspective. Okay. Go through this for homework. These are all just routine examples. Okay. These are all just routine examples. Okay. Now we have an interesting case when you have adjustment to quoted price when it does not reflect the fair price. Okay. I will give you an example. You will appreciate it very well. Okay. Which example should I give? Okay. Suppose I'm drawing this from two events which happened not very distant past. You would also be aware of it if you follow the news, and I'm pretty sure you guys follow the news. Okay. So I have investment in Google and investment in Coca-Cola. Okay. These are two things which have happened. I am on 31st March 23. Ind AS 109 requires fair valuation of your financial assets. So investment in Google and Coca-Cola are financial assets. They are investment in equity instruments. So I will have to do a fair valuation. ठीक है, तो मैंने बोला क्या बड़ी बात है यार, उसमें मैं कर लेता हूँ fair valuation. After all, these shares are traded on the NASDAQ, that is the New York Stock Exchange. So I will just pick up the value from there, and I have my currency exchange rate which is already available. So I just multiply that and determine the fair value, which is fairly correct. This becomes what? This becomes observable input. Sir, कौन सा hierarchy? Level 1. Level 1 input. So what are you going to do is you will straight away go to NASDAQ, and on NASDAQ, Google, Coca-Cola, they were trading at $1,000 per share, and this is $900 per share. I'm just making this up, but I want you to understand. Okay, fine. Now, this is the closing value. The exchange rate is 80. So ideally, your closing value should be 80,000 per share for Google. And this is 8 nines are 72,000 for Coke. This is, I will give that. I'll give that. Don't worry. I will discuss everything what you have to do for homework. Okay. So 80, 72,000. This is the value. This is a level 1 value. This is a level 1 value. Nowhere have I done any bias or any judgment. I have picked the value from the stock exchange. कौन सा वैल्यू है ये 31st March 23 क्लोजिंग स्टॉक एक्सचेंज वैल्यू. ठीक है. And I have taken the exchange rate. Multiply both of them. That gives you the value. Okay. Google and Coke have a fairly large value. Okay. So this is basically necessary for us to understand. Okay. Now, 31st March, NASDAQ closes at 4 p.m. US time. Okay. ठीक है. NASDAQ closed at 4 p.m. Fine. Google, listen to the story, conducted an artificial intelligence press conference. Google did an artificial intelligence press conference at 6 p.m. Okay. And in the artificial intelligence press conference that Google did, it was a disaster. Okay, you are all aware of this. I think it was Google only. Microsoft was successful. But when Google conducted the artificial intelligence press conference, it was a disaster. What was the expected output from the artificial intelligence software that Google designed? That did not work properly. And that did not work properly led to a pandemonium in the press conference. As a result, on 1st April, opening value of Google became not rupees. This will be dollars. $600 per share. $600 per share. What it was on the closing? Sir, it was 1,000. On 1st April opening, it fell down to 600. It was a billions of dollars of loss that was recorded. This is one case. Second case, there was the Football World Cup and Messi was attending the press conference. I think Messi or Cristiano Ronaldo, one of these two. Okay. And on his table, on the table where he was addressing the press conference, there were bottles of Coke which were kept. What this gentleman did, I don't recollect the name, but this gentleman only removed those bottles and kept it aside because he did not want to be an ambassador for Coca-Cola, because he was not supporting the soft drinks that they were marketing. Okay, so all that he did was, he did not say a word. He did not speak anything. Just the action of removing them from the camera's view because he did not want to be associated with the brand in any manner. This created chaos again, not in the press conference, but in the pricing of Coca-Cola. So on 1st April, opening value of Coke, this fell to $400 per share. Okay. This fell to $400 per share. Now, let me summarize the case for you. 31st March 2023 closing. Opening 1st April 2023. Just pay attention, understand. Google's price. This was 1000. It fell to 600. Coke. This was 900. It fell to 500. Now I'm asking you one question. Give me answers to that. What should be the fair value? You can tell me the dollar amount only. Forget exchange rate and all. What should be the fair value as on 31st March 2023? Because my books, I am preparing the balance sheet as at 31st March 23. You tell me, if you are preparing the financial statements, what would you take as the fair value? Will you take the closing value of 31st March 23? Because that is the observable input. It was genuinely observed in the market price of 31st March 23. Or should I take the dropped down values of 1st April 23 because there were certain events that took place between the closing market hours and thereafter up to the actual closure of 31st March 23 that gave a steep decline in the values? Which values will you take? Very carefully think and answer. Will you consider the closing values of March 23 as fair value, or will you consider this to be your fair value? When did these events happen? Okay. When did these events happen? The Coke as well as the Google conference. This happened on 31st March 23 after 4 p.m. Okay, it happened on 31st March 23 only. That means जो बजना था वो बच गया. What was the chaos that happened on 31st March 23? So now you tell me what is the value that you will consider. And these values had a lasting impact on the share price. Okay. Had a lasting impact on the share price. Okay. Because Google's artificial intelligence was expected to be something far better, which wasn't the case. And Coke's price took months to recover. It took months to recover to its current value. So therefore, these two events, though they are rare instances, they did have a lasting impact on the pricing. So now my question is, which value will you consider? Okay. Namita is saying opening. Namrata is saying opening. Shriram is saying closing. Janvi is saying opening. What about Panu, Viraj? What do you guys think? Mukesh, Tushar, आपको example समझा? Asha, Keyuri, what do you guys think? Uma, what do you guys think? What do you guys think? Okay. Everybody is saying opening value. You will consider the drop. Sir, but the drop happened on 1st April. How can you take the dropped value when in fact on 31st March you had the closing value, and Ind AS 113 gives you an option, gives you an explanation for this. If there is any event that occurs after the closing date, if there is any event that occurs after the closing time, but before the end of the closing date, and this impact is so significant that it affects the pricing on the immediately next day, then you will have to consider that price on the immediately next day. Let me alter this example and ask, suppose Google's servers across the globe caught fire, it will result in a chaos across continents, right? Because much of the data is stored on Google servers. What would be the impact? It would be tremendous. It would drop by probably 60-70% of its value, and it would have a cascading effect. At that point of time, you cannot say that this is the fair value, because the events have happened on 31st March 23. But sir, वो visible नहीं है. वो visible नहीं है. It's not visible because it did not happen by the close of market hours. When you are preparing the balance sheet as on 31st March 23, what are you looking at? Which balance sheet are you looking at? Sir, I will look at the balance sheet as at 11 hours 59 minutes 59 seconds. Suppose you are a bank. Bank hours close at 5 p.m. in the evening, 4:35 p.m. 31st March, 5 p.m. banks close. That means, according to you, the cash balance in the ATM at 5 p.m. should be considered. Am I right? That is what you are saying. But suppose customers will withdraw cash from the ATM between 5 p.m. to 12 a.m. in the night of 31st March 23. Will that withdrawal affect the bank's balance sheet? Definitely it will. Because the cash balance will go down, as well as the customers' accounts in the savings, the customers' balances in the savings account or current account will also go down. And this impact will be reflected right up till 11 hours 59 minutes 59 seconds, and after that the balance sheet will be drawn. So though the closing hours ended on at 4 p.m. or 5 p.m., you will consider the impact right up till night 12, because that is the date when you are going to give a true picture of the state of affairs as it existed on 31st March 23. The business is not as simple as it was a couple of years earlier, when all businesses used to close at 4 p.m. and then a balance sheet could be drawn, or 6 p.m., whatever be the time. Now there are events that happen right up till 12 at night because of the technological world that we live in, right? And that is why you will consider the impact of those events also which happen after closing hours up to 12 a.m. in the night. And that is why this impact of these two events is reflected in the subsequent pricing, You will have to show this in the balance sheet as on 31st March 23. But the question arises, if this is the case, it cannot be an observable input, because if the reader of financial statements looks at your investment in Google and Coke and says it is 600, 500, he will look at the stock exchange NASDAQ and he will say, but here the price is 1,900. If you are saying it is observable input, same value should flow here, but same value is not flowing here. Then how can it be observable? So the standard tells at that point of time, the measurement would no longer be considered a level 1 measurement. You have picked up the price on 1st April to ensure that you reflect the correct fair value as on 31st March. Between 4 p.m. on 31st March and 8:30 a.m. on 1st April, an event had happened and the stock market was closed, so the pricing could not be updated. But if it had to get updated, it would have definitely shown the value as on 31st March. So therefore, even though in this case, Coke and Google shares are listed, they have an observable input. You have taken that value. In spite of that, your quoted price did not reflect the fair price. In our example, $1,000 for Google was not the fair price as on 31st March because of that event which happened. And therefore, it became $600 on 1st April, which was reflected as the fair value. And you are taking that fair value on 1st April. And that is why when you take that, you cannot call it as a level 1 measurement. You will look at it from the lens of a level 2 measurement where you are making certain adjustments to that, where you are making certain adjustment. What adjustment you made? You have taken the opening price because it is reflecting the sentiment that existed as on 31st March 2023. Is it okay? Yes. Is it okay? Did you have, are you convinced, Shriram, and all the others? Are you guys convinced? Yes, Panu, are you convinced? Yes. This is the same question. Only thing is, instead of Google and Coke, it has taken the case of a biotech company whose clinical trials were not accepted after the closing hours. So the shares closed at 36, but next day it opened at 22.50. So you will adjust the quoted price and record shares at 22.50, and you will disclose the investment as a level 2 measurement. You will disclose it as a level 2 measurement. Okay. Please confirm. Shriram, did you follow? Asha, did you follow? Mukesh, Panu, did you follow? Uma confirmed. What about the others? Kayuri, Viraj, Tushar. Who else is there? Did you guys follow? Yes. Did you follow? Yes. Yes or no? Okay, fine. Many of them have confirmed. Okay, fine, good. So that takes care of this example. Okay. Now, valuation approaches. How do I do the valuations? So this is simple. You don't have to worry. First is market approach. Market values are there. Take that value, finish it off. Then you have income approach, something like a discounted cash flow approach using Gordon's formula. Do that valuation. Sometimes you would be using a cost or an asset approach. That means the net asset value. You know all these methods. Okay. So market approach means you use the prices for identical or comparable assets. Okay. And you use market multiples derived from a set of comparable companies. So I will do this example with you right now. Okay. Market approach. Income approach also I will do it right now with you. Cost or asset approach, I think there is one example. Let us check. Okay. So now we pick up a couple of questions. I have just made some small notes for those questions, which I have loaded on the BOS portal. Okay, you can just refer that. Okay, and I will be doing those questions through this because I have just written some extra points for you to understand. Okay, that's it. Okay, so now if you look at my notes, this is slide number 35. Question number 3. I have taken the same question here. Okay. So valuation methods. Normally we use something. No, you will be studying this in SFM in detail. Okay. You will be studying in SFM in detail. Okay. All right. So Namita, I'm not able to understand in high. Please write the whole thing. Aapka query as rebuttable presumption, so 1 point in high. You were talking about the, I have understood, so 1 point in high. Sriram, I will just complete the chapter, because if I take a 10-minute break, we will lose the flow, number one. Second is it will exceed the time. Okay. And I'm also a little tied up. Okay. So I will keep it simple, easy, just focus. In about the next half an hour, 40 minutes, I'll wind up the chapter and you can proceed. Okay. You can wind up. Namita, just tell me one thing. I mean, write it clearly in high. What is in high? Where were you discussing? I'm not able to understand the query. Okay, just help me out by typing it entirely. Okay, all right, fine. So, enterprise value, also known as firm value. You will be discussing this in detail in your strategic financial management. But as of now, just I have taken some concepts because we have questions on that. Okay. So enterprise value is basically value of debt plus value of equity. Okay. And in absence of any information, value of a company would generally be regarded as enterprise value. Okay. In order to find the value of equity, we can deduct the value of debt from the value of the firm or enterprise. So what it is trying to say is enterprise value is value of debt plus value of equity. So value of equity is what? Value of equity is nothing but enterprise value minus value of debt. So in a question, if you are given value of an entity, typically you take it as the enterprise value. From that you deduct the value of debt. So that will give the value of equity. That will give the value of equity. All right. All right. Next one. This is the presumption that is there. And when we talk about value of debt, KD is equal to debt minus cash. Whatever debt you are having, from that you subtract the cash which is available, because the presumption in valuation is you will use the cash to pay off the debt. So to that extent, you are not leveraged actually. So therefore it will be the net debt. Okay. So the value of debt is usually interpreted as net debt. That is total debt less cash and cash equivalents. Okay. This is based on the presumption that cash would be used to settle the debt immediately. So these three concepts are there, basis which we will check this question. ABC acquires 5% equity shares of XYZ Limited for 10 crores in the year. The company is in the process of preparing the financial statements for the year X2, X3 and is assessing the fair value at subsequent measurement of the investment made in XYZ Limited. Based on the observable input, it is now picking an observable input. ABC Limited has identified a similar nature of transaction in which PQR acquired 20% equity shares in XYZ for rupees 60 crores. Okay, fine. So the transaction is something like this. Okay. One second. Yeah, the transaction goes something like this. I am having ABC made an investment in XYZ Limited. Okay. This is the company. ABC Limited has made a 5% investment. Okay. For 10 crores. For 10 crores. And it wants to fair value it. It wants to fair value it. All right. Now, coming to the comparable transaction, PQR Limited. 20% is there. It acquired it for 60 crores. Okay. So this is the comparable transaction. First of all, understand what are we fair valuing. First of all, understand what are we fair valuing. We are fair valuing ABC Limited's 5% stake in XYZ Limited. So that is the fair valuation which we need to carry out. So now for that purpose, ABC has identified a comparable transaction. PQR Limited having purchased 20% stake for 60 crores in XYZ Limited. Okay. Now, the price of such a transaction was determined on the basis of comparable companies method by using the EV EBITDA multiple, which was 8. Okay. So now for effecting this transaction, the EV by EBITDA multiple was 8. EV by EBITDA multiple was 8. Okay. For the current year, the EBITDA of XYZ is rupees 40 crores. Okay. The EBITDA of XYZ is rupees 40 crores. At the time of acquisition, the valuation was determined after considering 5% liquidity discount and 5% non-controlling stake discount. Okay. So currently, EBITDA means earnings before interest, tax, depreciation and amortization. This was how much? This was 40 crores. Okay. Okay. And then they have considered the valuation determined after considering 5% of liquidity discount and 5% of non-controlling stake discount. Okay. What will be the fair value as at the balance sheet date? So this is what we are asked. Okay. So question is fairly simple. It is saying ABC wants to value its stake in XYZ. It has taken the comparable transaction of PQR Limited, which acquired a 20% stake. When it acquired a 20% stake, the multiple EV by EBITDA is 8. Currently, XYZ's EBITDA is rupees 40 crores. So now I want to do the valuation. So the question is, how do I do the valuation? So सबसे पहले, the first step that you have is, okay, so in the given case, valuation is done based on comparable companies approach. That is the market approach. I have a comparable transaction of the market. So it becomes a market approach. The comparable transaction being PQR acquiring 20% stake for 60 crores. So now how do I do the valuation? See, the EV by EBITDA multiple is 8. This is given to us from the comparable transaction. This is given to us from the comparable transaction. Therefore, enterprise value divided by 40 equal to 8. So, enterprise value kitna hai? Enterprise value is 320 crores. Enterprise value of XYZ Limited is 320 crores. What is enterprise value? Cost of debt plus cost of equity. Okay. So this is your value. Have they given any information about debt? They have not given. They have not given. Fine. We don't need that. Okay. Now, the above enterprise value is for the transaction of PQR. Absolutely right. Now we will have to convert it to my transaction of ABC Limited. We will now have to convert it to my transaction of ABC Limited. Okay. So how do I do the conversion? Well, let us look at that. Enterprise value for 100% stake is 320 crores. What is your stake? Sir, my stake is only 5%. So 320 into 5% comes to 16. Now, there are 2 to 3 points which are mentioned in the question. What is there? Well, they've told that determined after considering 5% liquidity discount, first discount, and second discount is 5% non-controlling stake discount. What has happened is I have acquired shares in a company which is not liquid, जिसको मैं आसानी से बेच नहीं सकता. there is some lock-in restrictions. There could be some minimum period of investment which is needed, and therefore I cannot sell those shares. And because I cannot sell those shares, I have pegged that at 5%. At 5%. Sir, how is this 5% arrived at? That comes through the valuation team. It is none of our concern as of now. Okay. This will always be given to you in the question. So 5% liquidity discount is going to be 16 crores, which is the investment value, multiplied by 5%. So 0.8 is going to be your liquidity discount. And there is another 5% non-controlling interest discount. What is this NCI discount? Well, when PQR acquired shares in XYZ, it has acquired a 20% stake. And generally a 20% stake means the company becomes the associate. PQR can exercise significant influence over XYZ. PQR would have appointed a member on the board of directors of XYZ Limited. PQR can participate in the decision-making process of XYZ, but it cannot control the operations of XYZ. It can only voice its opinion. It can only give the suggestions. Whether they will be implemented or not will be taken by the one who is controlling the entity, but at least this has given the opportunity to PQR to make its voice heard. For that purpose, it acquired a substantial share of 20%. Now, I have acquired a share of 5%. 5% में कुछ नहीं मिलता. You don't get any rights. You don't get any rights to attend the board meeting or take any decisions or make any suggestions also. All of us are holding 1 or 2 or 100 or 200 or 500 shares in listed companies, but हमारा कोई सुनता ही नहीं है. It is all handled by the major stakeholders, right? So in this way, when PQR invested 20%, he not only acquired the shares, but he also got the right to sit in the board of directors meetings. That means what? He would have paid some premium, because that premium is giving him the right to attend the board meetings and give the suggestions. However, ABC acquiring XYZ, this kind of transaction does not exist. Why it does not exist? Because I have not taken I have not taken the non-control, I have not taken the substantial stake to sit on the board of directors. Mera to sirf 5% hai. So I will have to reduce that, because that is the amount which I have not paid. So that value cannot be a fair value measurement, and that is why your non-controlling interest discount is going to be 0.8 and the fair value comes to 14.4. So that is how you do the enterprise valuation. I have explained for you what do you mean by liquidity discount, and I have explained what do we mean by non-controlling discount. Any doubts? Okay, so I have a question not related to this. Sir, how can we take Maruti Suzuki shares value for Volkswagen as goodwill of both the companies differ? Where did I say take the direct value? I'm always telling that take the value of Maruti and you do the adjustments. Do the adjustments for the segments, do the adjustments for the technology, you do the adjustments for the goodwill. So basically you are taking a comparable segment and you will have to do the adjustments. You cannot straight away plug in Maruti's value as the fair value of Volkswagen shares. That would be a criminal offense that you are committing in accounting terms. Okay. You will take Maruti's value and you will do the adjustments for that. Like how in this example, we have taken PQR's transactions, but we have done an adjustment to that for liquidity discount as well as NCI discount, because that is what we will have to do, because the transactions are not exactly similar. Volkswagen and Maruti are not identical companies. You will have to do some adjustments. So here also we have done those adjustments with a 5% liquidity discount and a 5% NCI discount. Did you understand? Others, did you follow? Yes. Did everyone follow this question? In highest and best use, are you talking about that, Namita? I think you're talking about that. Okay. Anyways, others, did you follow this? Clear? Okay, fine. So these are simple questions. What has happened is in your study mat, the explanations are not given. Okay. So I have tried to give that explanation for your reference. Okay. So please keep that in mind. You can do this, but in your examination, you don't have to give these notes. Don't give these notes. Usko malum hai what is a liquidity discount, what is a non-controlling interest discount. So there is no need for you to give that explanation. There is no need for you to give that explanation. Okay. All right. Coming to the next question, that is the income approach. Okay. I told you there are three approaches. One is market approach, which we just now saw. The other is income approach, which we are now seeing. And the third one is net asset approach. Okay. So we shall complete this, and that takes care of the approaches also. These questions I have uploaded already, Namrata. You can just have a look. Okay. It's uploaded. So please have a look at that. Okay. Late last night I uploaded. Okay. So slide 36, income approach. This is again taken from your study mat only. Okay. These are not extra. So this is what we have done. Then slide number 36, this is what I'm doing right now. Okay. So you can see the question. UK Limited is in the process of acquisition of shares of PT Limited. Free cash flows for the next 5 years are as follows. You have cash flows for year 1, 2, 3, 4, and 5. And you have the terminal value. Terminal value means value to perpetuity. If it remains in perpetual existence, what will be the value? So that is how we determine. That is how we determined. Okay. All right. Fine. Sir, practically these adjustments, see, you have to follow it. Some adjustments you have to follow, even though they are very difficult. Okay. Like, for example, very simple, Namita, if I have to tell you, absorption costing. It is so simple academically. Okay. But practically it is a huge exercise, particularly entities which are into the manufacturing industry. कितना बड़ा काम है वो to do the absorption of overheads into your inventory. It is not so simple, but करना पड़ता है. Otherwise your inventories do not give a true and fair view. They are not in accordance with the standard. So you have no option but to go ahead with what is there. So you will do just what is required. That should take care of the compliance with the standards. Okay. All right. So these are the cash flows which are given. The value till perpetuity, that is the terminal value. The weighted average cost of capital is given. Total debt is given, and cash equivalent surplus is given. Okay. The total number of shares of PT Limited is this number. Determine the value per share of PT Limited as per the income approach. So what you are given is cash flows. So enterprise value is going to be present value of all future cash flows. You are aware of it. Cash flows, you are given estimate of cash flows for years 1 to 5. And terminal value you are given, which is cash flows to perpetuity. That is from year 6 to perpetuity, normally calculated using Gordon's formula of pricing as under. You'll study this in SFM. P5 is equal to D6 upon KE minus G, where P5 is price at the end of year 5, D6 is earnings in year 6, KE cost of equity, and G is the uniform growth rate. Okay. So this formula would typically have been used to arrive at this price is what I am trying to tell. Okay. But again, it's not required. So solution, you know the cash flows. 187, 187, 121, 269, 278. You know, 1, 2, 3, 4, 5. All these are there. 5. And again, in the fifth year, you will have the terminal value. You will have the terminal value of 3965. Weighted average cost of capital is 11%, so that becomes the discounting factor. Important point to remember is this will remain the same for the last two, because these are the values at the end of that year. These are the values at the end of that year. So you will be considering this only and nothing else. Okay. And then take the present value. That gives you enterprise value. From that, you will deduct net debt. That is gross debt minus this is cash and cash equivalents. Okay. That gives you value of equity divided by number of equity shares. That gives you value per equity share. Okay. So that takes care of the income approach. So in the income approach, nothing is observable. If you see, this is an estimate. Terminal value is an estimate. This is an estimate. Only this is factual. That is the value of debt and cash equivalents. Only these are factual. That's it. Otherwise, rest are all estimates. So in your hierarchy, will this come under level 1 observable? No. Will this come under level 2 observable? Answer is again no. This will go under level 3 unobservable input, because what can I compare these inputs with? I cannot. It is unique to my organization. So therefore, you will not go ahead and compare it with anything. It is a level 3 unobservable input. Okay. All right. Have you understood this? Second question. Yes. Have you understood? Second one. Bolo. All right. Uma, Namrata, Asha, Shriram. Did you follow? Yeah. All clear. Okay, fine. I will leave this for homework, because it is just giving a combination. Okay, you are given value as per market, value as per income approach, and you have to assign equal weights. So what you will do is you will take a weighted average price of this and determine the equity value. That's it. So it is as simple as that. You don't have to do anything. So what the questions are trying to tell you is there is no standard way of determining the value in unobservable inputs. You can use market approach, you can use income approach, you can use a combination of both of them. Whatever it is, you will have to disclose it as a part of Ind AS 113 disclosures. Okay. So that is the question which you will do it by yourself, because it's just calculations. I don't have to explain the concepts there. Okay. So now we have completed this question and we have done this also. This is basically given for homework. Okay. So please do these questions for homework, and that should take care of the topics. Okay. So now we have completed valuation approaches. Market approach we saw, income approach also we saw. Cost approach is basically the net asset value approach. Okay. Net asset value approach. That's it. Important is valuation approach should be consistently followed. If there is a change, you treat it as an accounting estimate change and disclose the reason for the change. That's it. That takes care of my assets and equity valuation. So please refer these documents, this presentation for understanding. And now we come to the last part of our discussion, that is liability and own equity. So far we have been discussing everything relating to assets. So it came to a point that people started wondering whether liabilities are also fair valued, and the answer is absolutely yes. You will be fair valuing the liabilities also. Sir, why fair valuing the liabilities? Why not? It is when you are applying fair valuation principles to assets, why not to liabilities? And if you apply to liabilities, why not to equity? So you will have a fair valuation that is needed for these items. So where would you be applying fair values? You could be applying a fair valuation for borrowings or trade payables. This is as per 109. You could be applying for non-financial liability, example, advance received towards sale of property, plant, equipment. This is not as per 109. This is as per the respective standard. Okay. And this is, the next one is entities own equity instruments. As per 103, if you issue shares to acquire a business, then those shares have to be issued at a fair value. So your own equity shares, you will have to do a fair valuation. So these are some of the examples where you will have, where you can see that even liabilities are fair valued. Even my own equity which I am issuing will be fair valued. So the assumption is that whether it is a financial liability, whether it is a non-financial liability, or whether it is own equity, the assumption is these are transferred to a market participant, number one, and they will remain outstanding on the date of measurement. I told you yesterday also. Yes, the liabilities and or equity instruments will remain outstanding on the date of measurement. Again, for this also, maximize observable inputs, minimize unobservable inputs. Same thing. Transaction should be evaluated in line with an orderly transaction. That also we have seen. Okay, so specific guidance is provided while evaluating fair values of liability in case direct quoted prices are not available. Okay, so go through this example, read it, nothing different. It is just saying that you have a face value of 1 lakh, market value of 95,000. So 1 lakh is what we call as the settlement value. 1 lakh is what we call as the settlement value. 95,000, the market value, is what we call as the fair value. That is everything that is there in this example. 1 lakh, when you settle it, it means that the liability gets extinguished. That means liability kisi ke sar pe nahi rahega. But if you consider this 95,000 rupees, that is the market value, then your underlying presumption is what? This liability is not extinguished. It continues to exist. That is why you have liabilities like 95,000, etc., which are liabilities like 95,000, which will be disclosed as the liability value. This is the transfer value, not the settlement value. 95,000 transfer value, not settlement value, not a settlement value. So that's it, which is there, nothing else. Okay, and now applying fair value rules to liability and own equity. Okay, applying fair value rules to liability and own equity. Fairly simple. First one is your liability or your equity is an asset for a counterparty. A liability for you. Suppose you have issued debentures. That means somebody has subscribed to those debentures. So liability for you becomes an asset for somebody else. Liability for you becomes an asset for somebody else. Your equity share becomes an asset for somebody else. So that is what is the meaning of held by other parties as assets. So when a quoted price for an identical or a similar liability or own equity is not available. That means your liability is not available. Your liabilities price is not available. Your debentures are not listed. So your debentures do not have their own value. Then what the standard tells, okay, your liability is somebody else's asset. So look for identical assets and liabilities and take that fair value. Okay. So for example, I have issued a debenture, a compulsorily redeemable debenture. Okay. So don't think that this is a compound financial instruments, blah, blah. Don't go into all that. Seedha sada debenture hai. Rate of interest is 8%, 8% debenture, redeemable after 10 years, and interest is paid annually. 8% debentures, redeemable after 10 years, annual coupon rate. Okay, so this is what is your debenture. So you have issued this debenture and somebody has subscribed for it. Now that somebody who has subscribed for it also has an identical 8% debenture of another company. Your debentures are not listed, but that other company's debentures which he is holding, that is listed and that has a value. That is also similar 8% debenture redeemable after 10 years annual coupon. So when that is the same asset, same thing, yes, then what you can do, you can take the value of that asset, that debenture, and apply that as the value of your liability. So what it tells, when a quoted price is not available for liability or equity, then you shall measure fair value of the liability or equity instrument from the perspective of a market participant that holds identical item as an asset. My liability is somebody else's asset, but my liability is not listed. That somebody else who is holding, check if they have a comparable asset. That comparable assets price is going to be your what you can say is going to be your fair value. So again, same preference, use quoted price if it is available. If quoted price is not available, use observable inputs such as quoted price. And if nothing is available, then you calculate using the valuation technique such as income or market approach. Same thing, level 1, level 2, level 3. Acha. It is also possible that your liability is not an asset for somebody else. मतलब आपका provision for expenses are there, but it is not somebody else's assets. And when it is not somebody else's assets, then what happens is, how will you do the valuation? Okay, you will have to apply a valuation technique. From the perspective of a market participant that owes the liability or has issued the claim on equity. So this is how you will do the valuation. Okay, you will do the valuation for an item which is my liability but not an asset. Are you okay with this part? You would have understood, held by other parties as assets. Yes or no? Please confirm. Have you understood this? Held by other parties as assets. Have you understood the valuation rules for that? Okay. Not held by other party as assets. Are you okay with this part? I have a question, so don't worry about practically batao. But did you understand the cases of these? Yes. Did you understand the cases of these? Owes the liability means paisa dena hai usko. The entity which owes the liability means it is having to pay that obligation. Okay, it is having to pay that obligation. Have you understood? See, A Limited has an obligation. Unfortunately, this obligation is not somebody else's asset. This obligation is not somebody else's asset. So I cannot follow similar thing. So how will I do the valuation? I will look at a market participant's perspective who owes this obligation. And then I will do a fair valuation accordingly. I will look at the market participant who owes this obligation, Suppose I have a decommissioning liability. A decommissioning liability means basically it is a liability to set right the asset which you have taken on lease or rent or whatever. For example, you have put an oil rig in the sea. So oil rigs come with the condition that after you finish extracting the oil, you will have to remove the seabed damage that you have done and you will have to restore the seabed. This agreement is there right on the first day when you start the rigging. तो इसको हम लोग बोलते हैं decommissioning liability. Now you will use that oil from that oil rig for say 20 years. Today, how will I know whom I will appoint after 20 years for decommissioning that oil rig? I don't know. But today, is there a liability to decommission that oil rig? Answer is yes. So today's date, I have a decommissioning liability in my books. But who will execute that liability? Who will execute that obligation on my behalf? I do not know that. It's not possible for me to know that. And that is why, since this is an obligation right now, I will have to fair value this obligation. So how will you do the fair valuation of this obligation? You will be taking, you will be looking at whether other market participants are there with similar obligations, with similar with similar obligations. And if they are there, then what is the value that they take? You will have to consider that. So plain and simple, it's not so complicated as an asset. आपका liability है, go to a market participant, see if they have a similar liability, and that's it. That takes care of the accounting. Is it okay? Yes. Any doubts? Any doubts now? Perspective of the obligation. So this is just a chart which is put. Assume transfer and not settlement. Is there a quoted price? Yes, then use the quoted price as the fair value. If not, is it an asset for the other party? If it is yes, use fair value of asset. If it is not an asset, it is just a liability for you, then you will have to use a valuation technique. Sometimes you will have liabilities with transfer restrictions. Incorporate it in the fair value. No separate adjustment needed. Financial liability with a demand feature. You'll come to this instruments when you do financial liabilities. Okay. And financial fair value of financial liability reflects non-performance risk. Okay. So that is something you will study in the later part of time. So just go through this for homework. Okay. And we now come to the last question, and that takes care of my chapter. Okay. So coming to the last question, this is again an extra question which I have put in. First, we will do the liability question. And then we shall do the asset question, which is too simple. I mean, you will be able to do it by yourselves. Okay. Rohini Limited, a listed company. This is regarding that. It acquired an entity on 31st March 20X2, is required to fair value a decommissioning liability. The entity has to decommission. Decommission means उसको restore करना पड़ेगा. When you go to a mine, you will excavate and remove the natural resources. After that, you will have to put the mud back, level the land, do the road on top of that. तो इसको हम लोग बोलते हैं decommissioning liability. You will have to do a fair valuation of this. Entity has to decommissioning a mine at the end of its useful life, which is in 3 years time. Rohini has determined it will use a valuation technique to measure the fair value of the liability. If Rohini is allowed to transfer liability to another market participant, the following data would be used. So, labor and material, overheads, third party markup, entities non-performance risk, annual inflation rate, risk adjustment, and risk-free rate of government bonds. Okay, so you will have to discuss how the valuation of the liability can happen. Okay, so it's very simple, not at all difficult. Okay, you will have to measure the liability at fair value under Ind AS 113. There is no observable market to provide information. कुछ भी नहीं है. Okay, so Rohini will use expected present value technique. Okay, and what is this expected present value technique? If Rohini Limited were contractually committed to transfer its decommissioning liability to a market participant, it would conclude that the market participant would use the inputs as follows. So what is given? Well, I'm going to decommissioning the mine after 3 years. So मुझे decommissioning के लिए I will have my material cost, labor cost, certain overheads adjusted for inflation, etc., etc., and then give them the valuation. So how do I do that? Well, you can look at the data in the question. You can look at the data in the question. कहाँ गया Rohini? 1 second. Yes. After 3 years, you will incur labor of 14 crores, material cost and labor and material cost, and third party markup 20%. So this is what gives you the breakup. Okay, labor and material cost 14 crore, overheads 30% into 14 crores, so that gives you 4.2 crores, 18 lakh 20, and third party markup industry average, this is 18.2 crores into 20%. Okay, they have given it somewhere in the question. Third party markup 20%. Okay, so this is the valuations that you will be determining. 21 crore 84 lakhs at current cost. You will adjust it for inflation and you will adjust it for risk. So that gives you 26 crore 79 lakhs. You will discount it to present value. So this comes to 22.5 crores. And that's about it. Okay. So what do I look at? I will look at my cost, 30% overheads, and I will look at markup average on this value, 18.2 into 20%. That's it, 21.84. Adjusting for inflation, it comes to 25, 28, 25, 300. Okay, so that takes care of this. Nothing much. This was just a calculation that is there. Apart from that, nothing else is there. Okay, you do the first part of this homework. Okay, the first part of this is basically identifying what is the principal market, which is the most advantageous market, and determining the fair value. That's it. Nothing else is there. Okay, it's somewhat similar to that UP etc. question that we had done. Okay, so this is going to take care of your this thing. And then 1 second. All right, done. Will you do that question for me? Yes. Will you do this question for me? Have you understood that liability part valuation? I was a little fast, but have you understood that? Yes. Have you understood? The last part, did you understand the liability valuation? बोलो, नहीं आया समझ में तो मैं समझा दूंगा. Don't hesitate. Okay, you just work it out because this is the liability, labor, a markup, and that's about it. Okay, it should not take time. Okay. Okay, so that takes care you of this. This is a similar question. Okay. Similar. So please go through this question. These are all your RTP questions which have come. So at any moment they can be expected in your exam. Offsetting liabilities, you can offset and present the net value as fair value. You can do that part. So that you just read, just reading it out, nothing to solve as such. Okay. What are the rules for offsetting? That means suppose I have a debtor and a creditor and I want to fair value on a net basis. So can you do the fair valuing on a net basis? That is what it is talking about. I'll not value debtor entirely, creditor entirely. Jo net balance hai, only that will be fair valued. Some rules are there. That's it. Like you need to have a documentation. Similar other market participants also should do this. Market risk should be the same. So these are 2-3 conditions which are there. If these are fulfilled, you can do the valuation on a net basis. That's it. And important thing is, we always spoke about fair value being an exit price. But an exit price for someone could be an entry price for the counterparty. Could be nahi, it will be an entry price. So when you say fair value is an exit price, for the corresponding person also that becomes the fair value, although it is going to be an entry price. You are selling an asset, he is buying an asset. So for you it is fair value, for him also it will end up being a fair value, except under 4 cases. First case, if you are dealing with related parties, even though it is arm's length, we will not say that it is at fair value on initial recognition. Second one, if it is sold under stress or duress. Fourth one, if it is not on the principal or most advantageous market. Third one is different unit of account. I'll just explain it right now. If there is this issue where the transaction value is not the same as fair value, there is a difference which is there. You recognize it in P&L if you cannot attribute it to transaction costs. Okay. So now coming back to different unit of account, when will this happen? For example, a seller company is selling a division based on a slump sale. Slump sale kiya hai wo. What do you mean by slump sale? Assets, liabilities, everything of a particular division ek hi amount mein ja karke bech diya. So for him, it becomes an exit price of that particular division. That becomes the fair value. The opposite party who is purchasing the division, for that person, how can he record it as a single asset? He will have to do a split of assets. So for the seller, it is one division. But for the buyer, it is multiple assets and liabilities. उसने तो एक ही division में sale करके बेच दिया. So for the seller, the unit of account is a division. That is a group of assets and liabilities. But for the buyer, individual assets, individual liabilities. So unit of account is different. So the buyer will have to get a purchase price allocation report and allocate the price to the assets and liabilities accordingly. So therefore, if that is the case, then obviously the transaction value cannot be necessarily equal to the fair value. Okay, so therefore you will have to do a valuation and determine the fair value of each asset and liability accordingly. Okay, so that takes care of these questions we have done. Disclosures, just see what all are the disclosures we have to make, that is explained. Okay, so that is kind of completed the chapter, although towards the end it went a little fast. but liability and equity should be doable by yourselves. Okay. So anyways, let me know if you have any difficulty. We are meeting tomorrow as well as the day, as well as on Monday. So if there is any difficulty, you can ask me tomorrow as well. Okay. Now, Namita had a repeated question that in highest and best use, I think there is a rebuttable presumption that the highest and best use is yes. So we have a rebuttable presumption that the current use itself of a non-financial asset is the highest and best use, because you are a prudent entity, always looking for making profits, enhancing your capital, enhancing your net worth. So you will obviously, if you acquire an asset, you will look for that what you can say, that use which maximizes the worth of that asset, or which maximizes the worth of that asset. So therefore, highest and best use, you don't have to evaluate everything. It becomes your current use itself. Okay. So that is the rebuttable presumption that exists. All right. So with that, we conclude our discussion on Ind AS 113. Please, my sincere request, if you cannot solve it today, it is fine, but please ensure that you solve it over the weekend. Okay. Over the weekend, you will be having 102 also, which we will do tomorrow, and you will be having 113 also. So please at least ensure you solve 113 so that you will be comfortable. And if there are any doubts, you can ask me on Monday morning. Okay. You can ask me on Monday. Okay. So with that, we conclude the session. Any other issues or any other comments or questions that you have, please ask. I'm there for a couple of minutes. Please ask if there are any more difficulties or any more queries or anything. Yes, last 20-25 minutes was a bit fast, but I think it's manageable. Okay. So any doubts, queries? Bolo? Please tell me. I'm waiting. Yes. Janvi, Uma, Namita, Namrata, Mukesh, Shriram, Tushar, Viraj, Panu, Uma, Asha. I think many would have left for office. Okay. No doubts. At least as of now, nothing is there. Okay. All right. Go through it one more time. No problem. Particularly the last half an hour or 20 minutes, just go through that. If anything is there, we can discuss it later. Don't worry. Okay. We'll discuss it later. Okay. So with that, we end our discussion for today. Yes. Please revise and come. Tomorrow also, it will be a fast session because we have a lot of problems to do. Okay. So see you guys tomorrow then. Thank you, everyone. Thank you. Thank you. Okay. Done. Yes, yes.